Welcome back, folks, to part two of CIOs and bow ties. I'm coming at you from down under, whilst my friend Mr. Crook, I think, is in his, is that a tequila bar that's behind you?
It's part and parcel of my tequila collection. Directly behind my shoulders is, I'll lean over, is a collection of the 2019 La Familia de la Reserva by Jose Cuervo, my favorite tequila, I might add. I see we've got some Casa Azul back there. We've got 1942 by Don Julio, Coca-Cola collection personalized, and a few other bottles of La Familia.
Oh,
I'm
lovely.
a tequila drinker, and that's where we are today. Exactly.
Well, when I do get back from down under and we finally get together again, maybe we can toast to actually having, being in the same room again. Won't those days be great? And they will be back. They will be back.
They will be back.
So we were talking about the emotion of investing. We were referring to various charts around it. I think one of the difficulties when it comes to investing, now we certainly don't recommend investing solely based on emotion. I think that's kind of foolish, but then perhaps maybe ignoring emotion and investing only fundamentally might also be, a little bit naive. The problem I found though with emotion is that you never really know where the extreme lies. So as we just said earlier, we just went through a 10-year bull market, and the market was quite ebullient or euphoric for some time, but it continued to be so. Likewise with the fear cycle, fear can be really extreme. It can't last for that. Maybe it comes off the boil, but then you can certainly go back into another fear cycle. So it seems to me that emotions are good, but you never really know if you're at the extreme or how far the extreme is.
And I think that's perhaps the reason why you should have process drive what we're doing more than any other. Because with that being said, if the process determines how, when you're going to buy and or sell and or hold for that matter, then you take that emotional discovery completely out of the equation. So algorithms, for example, although they might be programmed to actually participate in some human emotion in some way or another, let's not forget that can certainly happen. But that being said, none of us, Greg, and I'm including everybody listening or watching this, and I have no idea how smart or market savvy the people are watching us. But that being said, none of us have the ability to find tops and bottoms at the right time in markets. No one knows where a bottom is. No one knows where a top is. Only with hindsight do you. So don't try, don't pretend, don't lie to yourself that you have the ability to do so. And then, of course, don't ever allow those emotional highs and or those emotional lows to get in the way of those decisions that you're making with regard to security or asset purchases or sales.
So what you're saying is almost to have a predetermined decision pattern, if you will, so that you take the emotion out of it by knowing at certain levels what you would do. In other words, let me just paraphrase. You buy a stock simply, you put in a stop loss order immediately, whatever, 20% below the market, wherever you feel comfortable, and you just leave it there. And it becomes almost programmatic, because once the stock, if it does go down 20%, your emotional makeup at that point is really different to when you made the purchase.
Indeed. And more often than not, you're leaning on your original thesis very often. And your original thesis might have changed without you recognizing that it's changed. So the investment environment at the time of, when things have dropped 20% is very different to it was when you bought it, whenever that might have been, past or just in previous times. So you also have to be adaptable. So not only non-emotional, but you have to be adaptable in being a good investor.
So how much of investing would you say is emotional? Or let me put it this way, in the market movements on a day-to-day basis, how much of that is emotionally driven versus fundamentally driven? And then when do the fundamentals actually have a bearing?
Craig, that's like asking me what I think the world's going to look like post-COVID-19. All I know is it's going to look very, very different, but I have no idea what it's going to look like. I know it's a big contributor to the way markets behave, i.e. the emotion. I have no idea what percentage it contributes to market movements, though, but it's larger than we would expect, I believe.
Yeah, certainly. I think leverage builds into the system as that greed cycle builds up, and that's what contributes to these huge waves, if I can call it that. Anything you'd like to say in closing, just on this part regarding downside protection versus riding the market on the upside?
Well, once again, this is an investment observation, Greg, and I'm convinced that over time, if you look at all times at a portfolio, at an investment, if you look at all times to protect the downside, more so than looking what the upside might be, you will come out over the cycle. You will be a better investor for it. Protect that downside. Don't be afraid to miss something on the upside, but at all times, make sure you're in a position to be able to protect the downside, and you will, over the cycle, be a better investor.
Yeah, as you said, FOMO is an incredibly strong emotion, specifically when you're at cocktail parties and everyone else is, making bank, and you're missing out. So we get it. We feel it all the time. All right, let's take one more break, Dave, and let you have maybe a tot of, no, just kidding on that. But I'm just going to go see what the sunset's like down on Bondi. And when we come back on part 3, we're just going to explore some of these recent, what I'd call extremes in markets, the negative oil price, negative interest rates. Let's see what that means from an emotional context.